Righty, let's get into a stock pick video. Now in this video I'll be going through two JSE listed stocks that I very much like, and I'll be breaking them down, telling you guys what they're all about. And if you're not from South Africa, you can still invest into JSE stocks. Just find a way, because we are evidently an emerging market. Before I get going, just remember I am not a financial analyst, and so whatever I say here is take it with a pinch of salt, go do your own research. I'm just telling you what's out there, what I like and what I look at in this company, so it's up to you to whether you want to buy it or not, or sell it or whatnot. I'm not telling you to buy it or to sell it or to hold it or to short it or to do something, okay? So the first company, and guys please just go do yourself a favor, go look at the track record of the stock price of this company. Afrimat, they're doing so good. It's a small cap stock, and they're really growing and they're doing some great stuff. I love the management style of this company. The CEO, Andries van Heerden, just the way he sees opportunities, and he's sticking to what the company knows and what the company does well, but at the same time, they also have a competitive advantage. And I've told you guys, invest into companies that have a competitive advantage. Otherwise, you're just getting a boring company. I know boring company from Elon Musk is great, but don't invest into a lame company that doesn't have a competitive advantage. They've got three main competitive advantage. The first is their structural cost advantage. They honestly have one of the best cost structures. And then secondly is they've got a very unique metallurgy-like approach. And metallurgy, what it is, I'm probably not even pronouncing it right, but it's pretty much material science. It's developing ways of working with raw materials, melting, smelting, all those things. And they've just got a very unique way of doing that. And then third competitive advantage is they've got a very diversified portfolio compared to other companies in their industry. For instance, one of their big things that they're making a lot of revenue from now is their iron ore production. Now, there's big companies like Kumba Iron Ore, but Kumba Iron Ore is only focused on iron ore production or like those type of materials, where Afrimat is a lot more diversified. So Afrimat has four main sectors to their company, and this is why they're so diversified. They've got construction materials, they've got industrial materials, they've got their bulk commodities, which is their iron ore section, and then they've got contracting services. Now let's first look at the iron ore section of the company. Iron ore's demand is really increasing, and they managed to mine their iron ore at $30 a ton. And currently the iron ore cost is at $100 per ton. So if you just look at that, that means their gross profit margin can be so big and so nice, just because, and that's where their competitive advantage comes in. Their cost structure is so low and they can make such a nice profit, and they move a lot of their iron ore products, they move out to China. So China is a big buyer of their product. Their iron ore division, they mainly focus on small deposits, so it's really, they've got the small mining approach, but they're still managing to have great operating costs compared to that and sell their products. Moving on to their construction materials division. Now, I personally think this is a big area. So their construction materials division, that ranges from giving bricks, some quick mix, cement products, like road cover service, subgrade service, like anything that you would need to build or construct infrastructure, they're there. And I mean, if you look at what the president of South Africa is currently saying, how he's going to treat the recovery of post the pandemic, is he wants to approach infrastructure, and infrastructure he wants to be the leading factor to the recovery post pandemic. And this company is perfectly situated to help that infrastructure lead and to supply the materials and supply the expertise to give it to them. And that leads me to their contracting services. Their contracting services range from drilling, milling, like sifting, like all the stuff that you need. And that's what I love about this management team. They've literally encompassed the entire industry in a perfect little bundle, and it's a company that's really well run, and they've got a great track record. And we're going to be looking at the financials and the ratios right now, and you'll see just how good this company actually is doing. And now, yes, I know Afrimat is also in the industry of mining anthracite. Anthracite is pretty much just hard coal. It's the premium coal that we use in our coal power stations and those things. But now it goes against everything I study and do in my masters and whatnot. But let's be realistic. South Africa is not going to get rid of their coal industry within the 5 to 10, probably 15 years. So they still have an industry, and because it's not their main source of operations, they are perfectly situated to get rid of it the day that they don't need it anymore, but at the moment they're still benefiting from it and they're not completely dependent on it. But it is a very good industry for them to get revenue from. So this company, and this is what I love, they are effectively debt-free. So guys, if you don't know what these ratios are that I talk about, or these financials, go watch my playlist on things I look at in a company, and then I'll explain to you exactly what these things are, where to find them, how to look at it, and how to read it. So let's look at some of the financials and ratios of Afrimat. So their headline earnings per share was up 48.5%, and that was to 347.7 cents. So if you move that to just the EPS, it's the 3.47. I mean, that's larger than one, and that's what we told you. You guys know how I feel about the PE ratio, but the PE at the moment, PE is 11 and the industry is at 9. So that would suggest that the company is overvalued. But if you look at the PEG, you get a 0.5. So that means it's undervalued currently. And I mean, we want to get an undervalued small stock and then have it grow. The revenue was up 11.4%. Their quick ratio is 1, which is obviously great because they can pay their bills. Their debt to equity ratio is 8.2%. Now, 8.2%, DE ratio of 0.08. That is amazing. Like, it literally means they're almost debt free. So all the cash and stuff they have, they can either put back into growing the company, or they can use that money and give it to you, the investor, as dividends. And that's why when you look at their dividends, is they've got a yield of 3.13%, which is great, and their payout ratio is only 11.15%. That is very sustainable, guys. So when this company is really situated to endure anything, and that's why also they've done so well during the pandemic time, is they've had this cash flow to fall back on. And then their gross margin is 32.23%, and then their return on equity is 30%, and compared to the industry, which is only 26%. Their operating profit is up 27.5%. That is crazy. Their cash and cash equivalent comes out to 167.5 million of cash that they have to endure just everything. And guys, literally, this is why Afrimat is honestly one of my favorite JSE stocks at the moment. It's really been doing great stuff, and our country is a developing country, and we have a lot of infrastructure still to build, and they are perfectly situated to endure bad times, but they're also perfectly situated to take advantage of an infrastructure boom. And as we know, the housing market is going into a seller's market, and that means a lot of more flats and housing, and everything's going to be built, and they are going to be there to help supply the materials. On that point of the housing market moving into a seller's market, we're going to go over to my second JSE stock.